I'm beginning to wonder if you can actually hear. So I'm going to play a little game first. Can everybody please stand up for 5 seconds? Can everyone please get up? Can you hear me? Can everyone stand up, please? We don't want to lose energy. Look at the person next to you. Say hello for 2 seconds. Shake hands. Shake your bodies. Move. Because when we ask questions on the stage, we want someone to respond. Say hello. 1 minute. Move your bones. Thank you. Can we keep this level of energy? Because we want this summit to be interactive. So that when speakers ask a question or throw a question into the audience, you're not all just looking blank. And yes, because you've been looking blank. It happens to me too. When I say something, nobody laughs. It's fine. I'm used to it. I know I'm not funny. Okay, thank you very much. You can take your seats now. And please keep that level of energy as we move on to talk around real estate funding. So we just heard about sales tips, being able to spot an opportunity, being able to know your target market, and all sorts of great tips that were passed on to us now. So let's continue to talk around real estate funding, which was something we did quite a lot yesterday. It is a huge area. We need funding to move our industry forward, and we want to ask how to mobilize domestic capital for real estate funding. This is going to be 15 to 20 minutes. I know it seems quite short, but 20 minutes or so presentation, and hopefully we'll have time for 1 or 2 questions. So I'd like to welcome to the stage Hakeem Ogunniran, founder, CEO, Eximia Realty and Home for Me, Nigeria. A round of applause for him, please. Thank you. That's the type of response we want. Thank you.
Sorry, can I have the pointer, please? Good morning. I have just 20 minutes. And when you spend like 6 months to prepare a presentation and you have to speak in 20 minutes, it's a challenge. Basically, what I've done in this presentation is to just share. 2 weeks ago, we were at the same forum for bonds, loans, and Sukuk 2018. And we discussed similar issues around how to mobilize capital. But today, we're talking specifically for mobilizing capital for real estate investments. And the challenges are slightly different. So I've taken a look at 2 critical issues, which I believe are very fundamental. Anytime you're trying to mobilize capital for real estate, there are 2 issues you must focus on specifically. Then I'll look briefly at money or capital market, how and where you should really be looking at, because real estate presents specific problems, and your capital raising must try to speak to those problems. Then I look at 1 or 2 options. There's something I've been doing the past 5 months. I'll just try to share that with you and why I think that's the way to go in this market. So basically, there are 2 issues. If you look at the capital market, capital and bonds market, the first problem you see is that government has a very, very dominant position. If I call it overreaching position. And most of the times, government tends to crowd out everybody out of the market. So if you look at the figures, size of the bond market today is $25 billion US. By the time you add federal and state governments, you already have like 24 point something billion dollars. All of us, the corporates in that market, and there are about 29 issuers today. I tried to count them this morning. All of us are doing just about $800 million. So you see, the government has a very, very dominant position in the market, and that's a problem. And the reason is very simple. We were having a conversation the other day with Mr. Falade, and I was saying that if I also sit as treasurer of a pension fund today, MPR is 14%. Everything is priced off the back of MPR. TB is 17, 18%. It will be difficult to take my money out of TB and risk my money on your real estate investment where you struggle to give me 7 to 8% yield with all the risk around it. So the government occupies a very, very dominant position. If you look at this end, look at the current size of pension funds and the current income split. Federal government securities is 69%. By the time you add with state, you're already looking at about 72%. For corporate, both debt and bonds today, is about 16%, which is decent. By 2015, it was just 3%. But just to show you how significant, and if you look at the value of bonds outstanding today, federal government is 90-something%. That is a major, major problem. Now, the other issue which peculiar to real estate, I always try to call it the 3 R's. You're mobilizing capital for real estate, you must focus on these 3 R's. Number 1 is the risk. And I've done roadshows over and over in this country. When you sit down before investors, they're looking at three R's. Number 1 for real estate is risk. The risk around real estate, particularly in this climate, is very, very significant. They tell you about the risk of title, risk of delays, macro volatilities. Look at what happened in 2015. We went to bed one day, woke up the following morning, dollar moved from 200 to 490 something, and that made a mess of all transactions. So they're looking at risks for you, risk of completion, market-related issues. Today, for example, if you come to me today, you're trying to raise capital for a grade A office, I'll ask you, by the end of this year, there will be 80,000 square meters of office coming to this market. So if you're doing a grade A office, who are your potential anchor tenants? Who's going to take it? All of us are busy just struggling with the same set of tenants, layering them with all manners of freebies just to move them from one building to the other. So there are market-related issues. There are macro volatilities. The second R for me is return. I always say that investment capital is rational. People go after the best of returns in the market. So if you have a real estate investment and you're trying to mobilize capital, you must understand that you are competing against other asset classes. You're competing against treasury bills. You're competing against all manner of assets. We don't have the kind of risk that real estate has. And so when you're pitching your case before the investors, you must understand that these are the issues they're going to ask you. The third R for me is regulation. Regulation is very critical. And, I always stress that if you look at those countries where they've made very good success of creating the right environment for raising capital for real estate, it's done deliberately. Now, the regulation here, very challenging. 2 months ago, I went to speak for African Real Estate Society on REITs. And I tried to look at the 3 major markets on REITs in Africa, South Africa, Kenya, and Nigeria. You'll see that for South Africa, they had 2 quasi-REIT regimes, PLTs and PUTs. And they took deliberate steps to merge both regimes and to have a comprehensive legislation for it. Because the standards are very clear. If you want to have a successful REIT in your economy, you must create a framework that makes you to be able to create standard flow-through, pass-through investment vehicles. But here we've tried to create a framework for collective investment schemes, and we're trying to force fit REITs into it, and that's why it's not worked. So regulation here, not well suited to real estate, and that is a bit challenging. I'll just skip this. I'm sure we know we know this. I always say that money market, largely unsuitable for real estate capital. Reason is simple. Typical gestation period of your project, 3 to 4 years. You can't finance that with 3 months' money. What will happen? You're going to run into trouble somewhere along the line. So your assumptions must be prim and proper. And when you sit before you, and I always advise, as an issuer, at one point in time or the other, you're also an investor. So when you go out as an issuer, all you need to do is also wear the hat of an investor. So you can think the way they think, and then you can pitch your investment properly. And I think where to go? Capital market. Because ideally, capital market is the medium for serious capital formation. You have access to a wider pool of investors. You have guaranteed rates for a long period. So you can match your assets and liabilities optimally over a sustainable period. I'll just look basically, I'll leave this. I'll look basically at the current and new initiatives. And this is very important because I think we should follow the trend, understand where to position ourselves if we're trying to raise capital. So what are the current and new initiatives? Number 1, bonds. But you'll see that there are 29 issuers in the market today, 29 issuers in the market, There are only 2 corporate bond issuers for real estate, and that is tough because it's been a bit challenging for others also to follow that particular market because of the requirement. CPs are also good, particularly when you are doing gap funding, when you are doing bridging finance. You could do CPs, but I will never recommend you to go the whole hog, to use CPs to finance your investment. Of course, there is REITs. Currently, there are 3 REITs in the country. But since we floated our REIT in 2013, I always ask, and I was having a conversation with Funke yesterday, why is it that no other REIT has been successfully issued? It's because the regulations are not very friendly. You really have to sit down and structure your instrument in a manner that you can meander through the regulation. So, but I'll say more about that just before I close. Short-term bonds. Short-term bonds is a new FMDQ initiative. It's 1 to 3 year bonds. But it's good because the disclosure requirements are simpler. The requirements are less complex than when you have to go for a 5-year bond with SEC. And you can also take advantage of that. New initiatives. FMDQ is currently working on private company bonds. I think this is very great because there are a lot of companies who are not listed who might be able to access this. SEC is working on credit-linked notes now. I think that will be ready in a few months, and we'll have opportunity to expand that band as well. New government initiatives, Sukuks, green bonds. Government issued the first green bond December last year, and I think that will also help to serve as benchmark for all of us. Now, what are the key issues? There are about 6 or 7 issues I always want to draw attention to. I already mentioned regulation. Regulation, the issue processes are just too complicated. MTN just issued a 200 billion bank facility. And they were asking them 2 weeks ago, why did you go to the bank? Why not come through a bond? And they said, we can't wait for 9 months. We can't wait for 8 to 9 months. Sometimes these processes are so complex and complicated. I mean, the last bond I did, there was a minor disagreement between 2 regulators as to what should happen, and we were just in the middle. And that caused us a delay of about 8 to 9 months. And in this market, 8 to 9 months is an eternity. By the time we came out, eventually, the market was already singing a new song. So the regulatory framework is very challenging, timing, delays, dearth of rating agencies, and sometimes some of these rating agencies, they don't understand the structure. I mean, I had an experience where we had a structure that SEC had approved in Nigeria, and we had a rating agency that wrote an opinion from their home country that the structure that Nigerian SEC had approved was a bad structure. And I said, guys, what do you mean? The apex regulatory body in this country had already approved this structure. Costs can be a bit expensive. Liquidity is a major issue. And that's one of the reasons why today some of these asset classes are not attracting the level of attention that we think they should be attracting. The parties, there are unresolved tax issues. It's one of the problems I have with the regulation here is that sometimes they are so opaque and you don't understand what to do with some of these issues. Up till now, we have not resolved the issue around tax. And I know that somebody will tell me that, last year, the new regulations, you can now achieve pioneer status for real estate-related assets and all those vehicles. It's good. But is that really an option? My answer is that is not an option. At the end of the day, the standards for REITs is the same globally. Investors are looking for an asset class that is flow-through and transparent. Until you have a regulation that helps to achieve that, it's going to be a major, major problem. And there's limited capital market penetration. We need to do a lot more of education. I mean, I sit before those that you would describe as savvy investors, and some of these instruments, they just don't understand, And when we floated our REIT, we focused a lot more on the institutionals. By the end of the day, I saw that by the time the result came, I was beginning to think in my head that maybe we should have paid more attention to the retail investors, because we also got quite some significant patronage from them. What I want to share with you is what I've been doing in the past few months. And I think that there's a sleeping giant that we should all think of waking up, and that is cooperatives. Now, cooperatives they're not very sexy, the way you look at them. They're not like bonds or REITs and things like that. But in 2016, something got me thinking. Suddenly, in 2016, Nairobi appeared on the GLL index, the City Momentum Index, global CMI, top 20 cities. And that got me thinking that, what happened? How come suddenly Nairobi is now rubbing shoulders with London, with Tokyo, and all those critical cities? So I decided to dig deeper. And I found that there are 3 fundamentals that you will see that has happened in Kenya. Number 1, there was a major legislative reform around title. Number 2, there was a proper legislation on REITs. But more importantly, they had a fundamental credit system, which they call SACCOs, which is basically cooperatives. So I started to dig deep. What is SACCOs? What do they do? How do they operate? How do they finance real estate? And like I noted in this presentation, Kenya has similar problems as Nigeria. 2 million housing deficit, 60% of the urban population, they live in slums. Access to mortgage is difficult. There are 25,000 registered mortgages in Kenya. And it is said that of those 25,000, about 80% are held by bank staff, because those who don't work in the bank, they don't have access to those mortgages. Now, how are they able to achieve the level of development that they've achieved in terms of real estate? It is through SACCOs. And SACCOs are your normal cooperatives. And then I remember that in 2013, I had done a deal here, built an estate, a cooperative showed up, and they bought the entire estate, 4.2 billion naira. So I think that we should. So in September, we launched our cooperative, and the result has been amazing. We're targeting 200,000 members in 3 years. Now, SACCOs now account for 35% of national savings in Kenya. 35% of national savings. By the end of this year, SACCOs will account for 26% of total real estate investment in Kenya. I was reading a report yesterday. World Bank estimates that 90%, over 90% of housing finance in Kenya is undertaken by SACCOs. So I think that we should revisit cooperatives. We have launched our own. I think it's a significant vehicle that we have allowed to just go to sleep, because through this, you can mobilize significant amount of capital. But you also have to do it in a different way. People know about Credit and Thrift Cooperative. When I was going to do my cooperative, I approached Lagos State government and I said, see, I want to do a specialized cooperative, a real estate cooperative. We had a lot of debate, but eventually, we reached a compromise, and they gave the approval, So it has to be targeted. It has to operate like a proper real estate creating vehicle. And I was mentioning to somebody yesterday, if you look at the latest SEC rules on definition of real estate related assets, it says that real estate related asset is RECOs, REITs, or any other vehicle approved by the commission. So I think that other vehicle will be cooperatives. I think that other vehicle will be limited partnerships when the new CAMA is eventually passed into legislation in the next few months. So overall, I think we need to think outside the box. The current traditional methods of capital raising for real estate in this country is very challenging. The regulations are unfriendly. The cost is too high. The process is complex. I've done this over and over and over and over. I've sat before investors, I've sat before pension funds, I was like their customer in my previous life, So we need to begin to think of, and over the past 5 months, I've been sourcing for capital all over the world, made a few successes here and there, but I'm convinced that one way to go to really jumpstart significant real estate capital mobilization is through cooperatives, And I think that the more many of us begin to look that route, we can then create the right critical mass that will gain the right attention. We can create the right framework, look for the right legislation, and Uganda has copied Kenya. So if you want to understand the system, start with Uganda because it's still at preliminary stages of development, And now they're moving gradually in that respect. Thank you very much.
Thank you.
I don't want her to start listening too much from me.
Thank you. All right, let's keep moving. We're going to continue that conversation around capital. We want to ask what is the role of pension funds in all this and in insurance assets? How do we unlock long-term funding? You mentioned just now risk, return, and regulations. How do we find the right balance?